Tonight on land speculation, the last few days have seen tremendous volatility. The silver market crashed and then maybe kind of rebounded. Cryptocurrencies have also crashed a little more gradually. Bitcoin is falling and falling and falling. And so tonight on Land Speculation, we are going to talk the basics of investing and make sense of the world when it comes to money and investments and the stock market and tariffs and all the stuff that is, I guess, going to determine people's retirements and all the kinds of things that people would do with money. That is coming up here tonight on Land Speculation.
Quack, 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 quack. Quack, 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 quack. Quack, 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 quack. Quack, 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 quack.
This is Land Speculation. That's something we do like Kinky.
Quack, 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 quack.
Quack, 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 quack. Quack, 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 quack.
Honk, 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 honk.
What's your money?
Got to be weird.
Ha, 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 ha. Ha, 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 ha. Let's see. I eat bars of soap for breakfast. I love bars of soap. After midnight, things get weird. Quack, quack. Let it go. Let it go. Cock.
I like that one.
Quack, 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 quack. Come on, ducks.
All right, guys, we are live here on Land Speculation tonight. Consider this a sort of Investing 101 stream where we're going to talk about, well, investing, and the state of the markets and crashes and all of everybody's like concerns and freakouts over what's going on in these various different stock and commodities markets and all that kind of stuff. Welcome, Jeanette, or Quiet Castle, I guess is first here. Jeanette and Spyman are the medal winners here out of the gate. Thanks, guys, for being here. Veliginac also, if you guys wouldn't mind dropping a like and a subscribe on the video. I very much appreciate that. Those likes help us out with YouTube. The subscribes help you guys know when we're on. Check our description, as always, for the links to our Discord and our Duck Fund. The Discord is our 24/7 chat platform. The Duck Fund is our Buy Me a Coffee link. We also accept super chats here on the stream, and then the description also has the link to our Land Ducks International sister channel, which we continue uploading videos on. All kinds of various raw footage. Today there was an elephant impeding on the roadway. So go check out the stuff going on in LANDCasts International. There's a lot of other stuff going on in the news right now. Obviously, there's a new tranche of Epstein stuff. I'm hoping maybe we can dig in a little bit more on that later this week. Bill Gates is all over the news, and so is Donald Trump and many, many other people, and people seem to be, as usual, quite outraged by it. And I don't know, other things. Immigration still splashed all over the front pages and things of that sort. But money in some ways, money matters more than any of it. Well, probably not really, like morally, ethically, maybe there are things that supersede it. But in terms of your individual ability to live your life, fulfill your dreams, and line your pocketbooks for your own retirement, and maybe so you can buy a yacht someday, so you can sail to the Canary Islands and visit the Great Canary Islands ice ducks. You need money. You need money to do that. And so we're going to talk a little bit about that because it does feel like people maybe have lost some money in the last few days. And actually, this stream is the product of a specific request from folks who posted in, well, at least one individual who remains unnamed, who posted in our questions and suggestions channel on the Discord. You too can shape streams here on Land Speculation if you post on the questions and suggestions channel on our Discord and or reach out to us individually. I always do appreciate that. And if you do that, we'll cover the things you want us to cover. And so we had a request to talk about the crash of the silver market, as well as other things silver. So we're going to do a little bit of that today. But we're going to talk about that in context, because silver has, in fact, crashed a little bit in the last few days and has since risen back up. Here is the trajectory of silver shares, or silver futures, going back to, this looks like about 2021. And as you can see, silver is one of those things that is an investment that is designed to remain stable over time, and so it did for a long time. 2021, 2022, 2023, 2024, into 2025, silver, amid all of the volatility of the stock market and other investment types, was swimming along very steadily. If you had silver, you knew it would retain its value. And then suddenly you got a Christmas present in 2025, which is that silver shot up in value. Kind of out of nowhere, silver shot up in value. It became a hot investment type. And as soon as it went from about 30 to about 100, the silver suddenly here in 2026 took a little bit of a nosedive the other day and sunk back down to about 85. And so people were kind of freaking out there that like in one day, over the course of like just a few hours, they lost a lot of money on an investment type that is usually supposed to be very, very, very stable. And since then, silver actually went back up over the course of today and seems to have stabilized a little bit and may continue climbing, but still is very, very, very much higher than it has been in the past. So lots of chatter going on about silver in the marketplace right now. There are other things going on here, and we're going to talk about all of the other craziness in investing today. But rather than just talk about one singular investment type or try to speculate about individual stocks or individual things that people should be investing in, which I don't even know like what the guardrails are fully around what you're like allowed to recommend to people on like an online platform. And so we're not going to do quote unquote recommendations for people about specific investment types. But we're going to talk about the whole ball of wax, the whole thing at large, and dig in a little bit here, because everyone's trying to get rich, everyone's trying to save for the retirements, everyone's trying to pay for somebody's college or something, saving up to buy a car or a house or a giant diamond or a giant ball of diamonds, or I don't know, whatever people are saving money to buy. What are you saving money to buy? Or have? Or live like? You can live like a king. Live like a king. You get a bunch of money. Everybody wants money. So we're going to talk a little bit about how you get some of that money and some of the different kinds of investments you can invest in. and exactly how those different investment types compare and sort of how they operate, and just kind of like talk about the whole lay of the land here. No pun intended. Hopefully, some of this will give you some tools to be able to make more money, to become more rich, and have everything go up and up and up and up into the stratosphere so that we can drive infinite inflation behind it and reduce the value of the dollar. All right. Well, anyway, this is the New York Stock Exchange. This is the most famous, probably money-related place in the United States. This is basically, well, it's right there, kind of in lower Manhattan. They're at Wall Street, very close to the tip of southern Manhattan. This was the old Dutch part of old New York City. And you can't really see much into the building, but you can certainly see the outside of the building. The famous old stock exchange where the stock traders go in and buy and sell and make the world go round, at least during the workday on weekdays. The stocks are only technically traded during official work hours. And so, it's a little bit limited, but usually this street is just chock full of people. This must have been back during COVID or something. I don't know why there would be nobody out here during the day. I've been here many, many times actually during the day. I used to have reason to go to basically the site of the New York Stock Exchange very, very frequently. And so I spent a lot of time walking this little portion of Wall Street. And it was always mobbed with people as well as little street performers and things like that. And it sort of carries the weight of the American economy. It's a pretty compelling place. Of course, it's surrounded by cavernous high-rise towers on very narrow little streets in the old meandering part of lower Manhattan. And you can't help, when you are walking by the stock exchange, feeling like you are walking amid gravity and amid history. Americans have some $70 trillion invested in the stock market, which is a hell of a lot of money. We think our national debt is big, but the collective pool of money Americans have tied up in the stock market is really, really astronomical. Of course, the amount of money that Americans have just invested somewhere is really, really, really astronomical. Not many people have money just sitting under their mattress. I guess even if you're holding on to money, that's sort of an investment. Kind of anything. Anything is kind of an investment. Like once you get paid, you have that money, you've bought an investment of some kind. Even if you have gold stashed away in a bag in your closet, that's an investment. So what should you be doing with their money? Well, stocks certainly are part of that equation. We'll talk a little bit about that here. And the New York Stock Exchange you don't have to go to the New York Stock Exchange to do stocks. But this is kind of the epicenter of it all, where the trading floor actually exists. Obviously, a lot of this is now on the computer. But the trading floor is still the center of activity. And you can't help but feeling the history of the stock exchange. Because stocks, historically, across American history, have done very well. And it's not abstract. The reason stocks do well is that the American economy has grown. People have invented things. People have innovated. And people have created a better quality of life for their fellow citizens. And so just as we no longer operate in horses and carriages and the antiquated technologies of the 1700s, investing in the stock market has been investing in the growth of the American economy, which has now become, at least for a large country, the most prosperous thing in the world. The American economy has a lot going for it. When you invest in stocks, you're investing in various aspects of the American economy. You're lending money to companies so that they can invest that money in creating things and selling those things to people and hopefully generating a return on those sales, those investments, and growing their company and in turn growing the return to you. And yet, much as the stock market has grown, much as it has been a source of wealth for many people, much as it has increased the value of people's portfolios, it too has seen its harder days. You can't help feeling the history of things like, well, there's the trading floor. There's the trading floor of the New York Stock Exchange. They used to have, like on TV, they used to have the bell. The bell would ring, the more sort of a prestigious thing. I guess they still do that, but it doesn't get as much press on TV anymore when people ring the bell to invest in the stock market. But it's still a pretty interesting thing to see. When you go to the stock exchange, though, you can't help but feeling the history. This is 1929. 1929, when the stock market inexplicably in the middle of that year started declining after years and years and years of seemingly unimaginable increases. The stock crash of 1929 is a little bit overblown in its suddenness. It was not all of a sudden, although Black Monday happened and the stock market fell substantially over the course of that week and over the course of the next several months, dropping an astronomical portion of its value over the course of 1929 into 1930 before, and it took it like another several decades to rebound from the crash of 1929. People had really wildly speculatively invested in stocks back then. There was a thing you could do back then where you could invest on margin. You put up only 10% of the actual amount of money you were investing into the stock market. You were highly over leveraged. And then eventually you would, as long as the thing kept going up, it was sort of like a pyramid scheme. And then the second the thing started going down, a lot of people were made very destitute very quickly. But, when the thing started going down, people were like, they mobbed the streets. Nobody could understand it. All that trust, all that faith in the American economy that people had in the 1920s started eroding. In these days, people don't have a lot of faith in various aspects of the American economy. At least some people don't have faith in American stocks. And so people have been looking all over the marketplace for other kinds of things they can invest in. These are the world's 10 largest stock exchanges. The U.S. is the largest epicenter of investments anywhere in the world. Of course, the U.S. is the world's wealthiest country. It is the world's biggest economy. And per capita, it is by far the world's largest economy. And the New York Stock Exchange and the NASDAQ, the two big stock indexes in the United States, are by far the two biggest stock indexes in the world, although you can invest in international exchanges as well. Certainly the Japan exchange became really a big deal back in the 90s. You can invest in things all over the world and all kinds of different kinds of investments. And that's what we're going to talk a little bit about here today. But the U.S. continues to be the epicenter of that. And so people here in the U.S., because we have expendable income, because many people earn more than they spend and try to build for retirement, people are invested all over the place in many different kinds of asset classes. And so that's life in America these days, as you try to fight the rat race, not just for your own, like you go to work to make money, but then the question is, what do you do with that money? And everyone's trying to make more of it. Everyone's trying to generate a return. But as you consider between various different kinds of investments, fundamentally, the question is not just what is going to make you the most money, what has the greatest likelihood of making the greatest return. The risk is part of it too. And so the relationship between risk and reward is really ultimately what investing is all about. Every kind of thing you can invest in has some kind of return that in theory it could generate that is not guaranteed. And everything you could potentially invest in has a level of risk, a level of volatility to its potential return that could be really high, it could lose you money, it could be somewhere in between. That also must be weighed against the potential reward. So how do you think about that? If you could make $100, but there's a big chance of losing money along the way, is that worth it? Or would you rather take a surefire $10 bet? That's the question when it comes to investing. A lot of people focus only on the top line. How much can you get? People go crazy. They look at Bitcoin. It's like, oh, well, boy, I could make a ton of money on Bitcoin. Well, you could, but it's also very volatile. And then there are other people that are like really afraid of risk. My grandmother was one of those people. Somebody grew up in the Great Depression, really afraid of a repeat of the stock market crash. And so she was afraid of stocks. She didn't like them. And so she avoided the stock market at all costs and missed out on a lot of potential upside along the way. Risk versus reward. Where does it all land? Everything falls somewhere along the continuum. And so, I don't know, as we talk about some of these investment types, we'll talk about that. Talk about what silver means, what crypto means, what some of these major assets mean. We're talking about risk versus return. All right. There are a number of areas where you can, in theory, invest your money. So I thought we would do a little quick run through of what some of those things are. Obviously, one thing you can do with your money, if you so choose, is you can just hang on to cash. You can cash out the check that you get from your employer when you get your paycheck. You can just get a big bundle of American currency. You can hope American currency retains its value. And you can stock that under the mattress or in your shoe or in the closet. And you can just hope for the best. A lot of people do that. It's not necessarily a great way to increase value over the long term because cash eventually, it erodes due to inflation. Cash becomes worth less over time. But cash can be lived in many forms. You have highly liquid holdings like savings accounts, money market accounts, treasury bills. Those are all different kinds of cash. Basically, more or less static investments, which are designed to preserve capital. They do provide you immediate access to the money. Like it's a real liquid investment. So they say liquid investment, meaning like you can access it any time. Whereas if you invest in the stock market, that's like a theoretical investment. You've just given some company your money. You're only pretending that that money is actually worth anything while it's in the company's hands. You're just trusting that someday when you take that money out, you might get something more in return. So cash is most certainly part of a potential investment equation. You can invest in cash and it smells good. Kind of, it's like fresh, it smells good. Cash is kind of exciting. So cash is number one. All right, number two is bonds. So bonds get a little more complicated. This is another fixed income kind of investment. A bond is generally like a loan that you are making essentially to a government. So you invest in a bond, you loan it either to a government or to a company. They pay regular interest rates and they return your principal at the end of a particular period. And you are basically guaranteed your money back. As long as you trust that the bond won't default, you are basically guaranteed your money back with a little bit of interest when you invest in a bond. Usually bonds in government, like cities, are considered pretty stable because a city's not going to collapse for the most part. Corporate bonds generally also considered pretty stable because the company has to pay those back. And that's why, in fact, that they're very stable is part of why they don't actually pay that much on a return. They're a little bit more lucrative than cash, but they're also just a little bit riskier. And then there's stocks. And so when we think about the landscape of different kinds of investments, about 10% of American investments are held in cash. About 30% are held in bonds. And another 35% or so, the biggest plurality of investments are held in stocks, basically investments in public companies. When you are investing in a stock, otherwise known as an equity, you are buying an ownership share in a publicly traded company that participates in profits and growth. And it's exciting. You can buy part of any of the major companies of this country, provided that they are traded on a stock exchange. It's very exciting. You can go buy like a giant oil company. You can go buy Toys R Us. You can go buy McDonald's. You can buy Amazon. You can buy Google. Like, it's exciting. You can buy into these companies and you literally become an owner of those companies. Stocks can be a lot of different things. By and large, stocks pay bigger returns, of course, than cash. Generally, when you're sitting on just cash, you're going to get a return. Well, stocks are basically just straight cash is going to be more or less like a negative return, basically. If you're investing in like a money market account, you get maybe 2%, 3%, 4%, a certificate of deposit, you get 2, 3, 4%, but low risk. Bonds, maybe 3%, maybe 5%, but low risk. Stocks, over the long term, tend to pay somewhere between 7 and 10%. But like with a really, really wide level of variability. A little bit higher risk. Stocks can mean many things. It depends what company you're investing in when you invest in a stock. And basically, you've got like really big companies. They tend to be the lowest risk. And then you've got smaller and smaller and smaller and smaller companies, which tend to be the highest risk, but also have the potential to pay the highest return. And so even if you're just investing in stocks, you can build a very variable portfolio of mega, large, mid, small, micro cap stocks. Generally, an investment advisor would tell you to buy a mix of these different kinds of stocks, like to build a foundation of your portfolio that is the big stuff. You know, the Amazons, the Googles, these big behemoth companies that anchor the American economy. Johnson and Johnson, these like stable goods companies that you can trust that make like the basic things that we all live on. You invest in those companies, you're trusting that the American economy is not going to collapse in some kind of doomsday scenario. But for the most part, you can more or less trust that people are going to continue eating soap and shampoo and the basics to stay alive. And so you can invest in some of those bigger companies, then you stack on top of it some of these smaller, more speculative companies that have more risk but more potential return. Of course, the stock market spans the entire breadth of different industries. You can invest in stocks that are in basically every sector of the economy. Communication, IT, financials, healthcare, consumer staples, industrials, materials, energy, real estate, utilities. There are stocks for basically all of these different things. You can build a stock portfolio comprised of virtually anything. The world is your oyster. And a lot of people get caught in these wormholes of trying to pick the winners and losers of individual stocks. There are people who are paid every day on Wall Street to understand these industries in tremendous detail, to parse through financial reporting, like all of the profit and loss statements of these individual companies, understand their underlying assets, and figure out which of those companies are likely to perform better or worse in the future. So when you go about trying to pick an individual stock based on some kind of gut instinct or some article you read online about the future of this or that industry, just remember that you are competing against every analyst on Wall Street. So you can invest in a lot of different sectors of the economy. You can also invest in international stock markets, which are interesting sometimes. There's a lot of complex variables there. Obviously, America is not the only place with companies. Other countries have companies too. Airbus is based in France, for instance. You have lots of companies on the Tokyo, Hong Kong, Singapore, Jakarta, and Sydney stock exchanges. You can buy international stocks. Last year, after many, many, many years of not doing as well as the American stock market, last year, international stock markets did extremely well. If you were invested in international stocks last year, you likely made a fortune. And they were kind of catching up to American stocks, which had outperformed them for a while. The American dollar did not do very well last year. And so international stocks became more valuable for that reason too. And so you're picking and choosing. Do you want American stocks? Do you want big stocks, small stocks? Do you want this sector of the economy, that sector of the economy? Do you want American stocks versus international stocks? There's a lot to choose from. And so it can be very daunting to try to build a portfolio that you think will make you money. Again, these are the largest stock exchanges in the world. You've got the New York Stock Exchange, you've got the NASDAQ, you've got the Tokyo Stock Exchange, the Shanghai Stock Exchange, you've got the Hong Kong Stock Exchange, you've got Euronext, the London Stock Exchange, you've got the Shenzhen Stock Exchange, you've got the Toronto Stock Exchange, the Bombay Stock Exchange, the National Stock Exchange of India, you've got the Swiss Stock Exchange, you've got the Australian Securities Exchange, you've got the Deutsche Börse Stock Exchange, and you've got the Korea Exchange, and then many, many, many other much smaller exchanges all over the world. So there's a lot to choose from. Now, Quiet Castle is alluding to it here in the chat. If you don't feel comfortable picking individual stocks on your own, there are ways you can get around that. for a slight fee. Mutual funds are one way around that. Mutual funds are basically where you're paying somebody else to make the decisions for you. And, that can be a lucrative decision if you don't necessarily trust yourself or have the time to make all the decisions about what kinds of things you should be invested in. Mutual funds effectively are pooled investment vehicles, which are managed by professionals that invest in diversified portfolios of various securities. To put that in lay speak, somebody out there whose full-time job it is to manage some kind of fund they're picking and choosing the stocks. And all you have to do is invest in their fund for the price of paying them a percent or two every year for the privilege of managing your money. And so if stocks are earning between 7 and 10% a year, a mutual fund might earn just a little bit less because you're paying a fee on behalf of the person that is running the fund. But maybe, just maybe, you trust the person who's running that fund to pick and choose the investments better than you can, and maybe they'll earn a return that is better than the stock market overall. Maybe. Just maybe. The value of mutual funds is basically determined at the end of each day, which differentiates it from the next kind of investment on the list, which is ETFs, which many people confuse with mutual funds. They're a little bit different, but they function very much in a similar fashion. As opposed to a mutual fund, which is basically the value of which is calculated at the end of every day, ETFs are a little bit more automated. ETFs stands for exchange traded funds. These are basically pooled indexes, basically collections of like funds that are comprised of basically a representative sample of the entire stock market, or an entire index, or an entire portion of the stock market. So rather than trying to invest in individual stocks, you can instead choose to invest in the entire market overall by investing in an ETF that represents, say, the performance of the entire S&P 500. It's a good way to minimize your risk. If you believe in the economy overall, but you don't want to have to pick and choose individual companies, an ETF is a good, simple vehicle to just park a fair bit of your money and try to grow it alongside the rest of the economy. And they've been increasing in popularity. More people invest in ETFs than they did in the past. One of the fun kinds of ETFs you get are these leveraged ETFs. Basically, you guys, I'm not going to get into the details of options and derivatives in this stream, but basically there are mechanisms where you can place bets on the performance of individual stocks or the stock market overall. Those are really, really, really risky because you're not investing in the actual asset. You're investing in a bet on the performance of that asset, which can get very complicated very quickly. But there are versions of ETFs where you can basically augment the level of return in an underlying index, but also the underlying risk. So one of my favorite, it's one of my favorite kinds of things, these triple leveraged ETFs, where you can invest in the overall performance of the S&P 500, basically the overall performance of the stock market. You can invest in that, but leveraged, so it amplifies either the return or the loss by 2 or 3 times over. So if the stock market were to gain 10% this year, those funds would in theory return about a 30% return to you. But conversely, if the stock market loses 10%, you would lose 30%. And so those get kind of messy, but they're sort of fun if you want to really, really try to pump the gas on your investing dollar. That's one way you can do it. Now, there are many, many other kinds of investments outside traditional stocks because the economy is actually comprised of many other kinds of things. Direct ownership of real estate is one kind of investment. The returns are a little bit different. This is when you own physical property, like physical real estate development that generates income as well as potential appreciation. Sometimes real estate can actually outperform the stock market. It just really depends how it does overall. Generally, when it comes to real estate, you're looking at returns that are, let's see, 6 to 10%. It's going to be really high, depending on the kind of real estate that you're looking at. But there's some risk to investing in real estate. If you don't want to invest in an individual building, which can be very risky, because who the hell knows what goes on there? Like an earthquake hits the building, a fire, some tenant like burns a bag of popcorn that ends up exploding the entire building. That can like decimate the value of your investment, as well as putting your entire livelihood at risk. And so there are ways to pool your risk and let the professionals do it. REITs are larger pooled real estate investment mechanisms. These are basically companies that own or finance income producing real estate in large pools. They pass most of those earnings on to investors. And so you can earn a decent return on real estate with medium to high risk. Real estate can be risky though. The greatest value of real estate is that it earns a little bit out of sync with the stock market itself. Like even as the stock market has increased over the last few years, commercial real estate values have plummeted because after the pandemic, everybody decided they wanted to work at home. And so everyone has disinvested from corporate real estate. Commercial real estate, I should say. And so that would have been a bad investment. Residential, doing better. Doing better. That's one place you can go. Okay, then you can start to get a little more niche with your investments if you want to get out of the public, the public stocks and public funds. You can invest in private equity. So private equity, not everything is traded on the stock market. Private equity is when basically you are making an investment in an individual private company that is not sold on a public stock exchange, or making a buyout of a company aimed at improving the operations of that company with the goal of eventually exiting at a higher valuation. Think the investors on Shark Tank that are investing in individual products and individual companies off of the stock market and hoping they achieve a return. Now, every dollar you put into the latest ShamWow product you see on Shark Tank is a dollar that you otherwise could have been investing in the stock market. And so it's not just a question of will that investment make any money. It's a question of will that investment make you more money relative to the amount of risk you're taking on in trying to earn that money as compared to investing in the stock, just a regular stock in the regular stock market. For some people, it's kind of fun. Like you're looking for products. The stock market's kind of boring because you feel like you have no say in it. When you're a private equity investor, you're buying a bigger stake in that individual company, and so you get to determine a lot more of what's going on. And you get real sharks that invest in private equity. Related to private equity, but a little bit different, is the notion of venture capital. This tends to be less about buying established companies and more about buying into early stage high growth companies that have high failure risk but really high upside potential. And so venture capital is very risky. Venture capital can earn you on a successful investment between 15 to 25% or more. It's a really successful company, it can earn you a lot, but these are very, very high risk investments. And so it's also kind of hard sometimes to access venture capital. There are, of course, venture capital companies that specialize in this kind of investment, and you'll be competing against them when you try to invest in a speculative investment. There are other things too. Let's see what we got next here. Oh, the good old hedge fund. Hedge funds get even slimier. Hedge fund is basically an actively managed pool in which you'll basically try to maximize value via any means. You're not necessarily trying to like grow and increase a company per se. You're just trying to maximize as much money as you can when you own a hedge fund, which means you're going to use flexible various strategies. You're going to use leverage. You're going to basically just try to like invest in things as a fund to try to generate absolute possible returns. And those can get pretty darn risky. So hedge funds can earn, decent returns, but again, relatively high risk when you operate a hedge fund. And it's hard to get access into hedge funds sometimes. Which all brings us to the things people invest in to hedge against the risk of some of these other kinds of typical economic investments. Things like commodities, which represent investments in physical goods like energy, metals, agriculture, pigs and cows and corn and things like that. These are basically investments because people don't trust other aspects of the economy. Sometimes people invest in them because they know them. Sometimes people are like, I don't know if that stock market's going to crash, and so I'm going to invest in something that I know will retain its value, like gold or silver. Now, there's no guarantee that gold or silver will retain its value either, because the value of everything is simply the amount of worth that people place on it. But the value that people place on silver and gold tends to be more stable and less volatile than the value that people place on stocks. Because it is a stable, fixed metal, as opposed to a company that can either become more or less valuable, it tends to hold its value a little bit better. But it also isn't generally going to return you a massive return. When you invest in gold or silver, we'll get into some of those specifics here in a little bit, you're banking on a little bit lower of an annual return, between 3 and 7% typically. There is risk associated with these increasingly recently. These are a little bit less stable than they used to be. These get hawked endlessly on conservative media platforms because generally the people doing advertisements know that conservatives, by and large, are a little bit more skittish when it comes to risk. Conservatives are like, boy, I don't know, I'm feeling the threat of change just a little bit more. And so conservatives are the kind that, they're more likely to have a big like emergency bunker where they're stashing canned goods in the event of the apocalypse, as opposed to, free range liberals out there who are like floating through life without a care in the world. Conservatives are paranoid, liberals are flighty. And so conservatives tend to gravitate toward investments like commodities. These are hedges against inflation. They can hedge against the volatility of the stock market. They can move in different ways. And, having a bar of gold or silver, they look very tasty, which is kind of fun. Invest in platinum. Platinum could be the ticket, says Jerry Carter. Yeah. So, commodities are kind of fun. Commodities come in a lot of different types. These are just some of the different kinds of commodities that exist. There's like energy commodities. Those can have pretty high returns if you invest in like an energy fund. There's industrial metals. These are the kinds of invest in metals that get like put into smartphones and things like that, automobiles. Those have like value into the economy. Those can return a relatively high return, but they're also high risk. A lot of those metals are buried under places like China. Makes them a little bit risky. As opposed to gold and silver and platinum, which are known more as precious metals because they don't get used as much in practical things, but they hold intrinsic value over time. And so they have a little bit lower return, but a little bit more stability. Agricultural crops represent another kind of commodity you can invest in. Those don't generally return a lot, but they have predictable returns if you know the market, if you can sort of read what's going on. Of course, they're subject to impacts like weather and seasonality and fuel accessibility and tariffs and things like that. Some little invasive bug species shows up. They can decimate a particular crop yield in a particular year. Mad cow disease goes and infects all the cows. Suddenly, cows are not a very good investment this year. Soft commodities. And fertilizers and inputs. Fertilizers, yeah. I don't know, a lot of different kinds of things you can invest in the commodities market. You check the newspaper, you can check the price of hogs every day. Really fun. And then you have like the alternative stuff. These are kind of fun. You can invest in other things, the sort of high end, these like sexy investments like wine, art, or like you can invest in art of wine. It's kind of like you invest in a painting of wine. And people will do that because they believe that art is pretty stable. Like people will always be willing to invest in art. And so art tends to hold its value, maybe even increase in value. You know, if you invest in a Vincent van Gogh painting and you preserve it well, will it increase in value over time? People invest in other things like sports teams. That's another thing you could invest in. That they tend to be relatively stable because people always like sports even when there's a recession. You can invest in things like crypto or other kinds of speculative things like non-fungible tokens. There's a million different frickin' things you can invest in here. And they all have different returns and they all have different risk, and that's where the metal meets the money or whatever. That's what you really got to decide for yourself, is what kind of return do you think you're looking for? How much do you trust in these different investment types, and how much risk are you willing to carry on your shoulders in doing it? Are you willing to risk high volatility for a big return, or do you want something very stable, even if you miss out on high upside? Now, because investments also become exponential, you got to think about that too. It's not just the difference between earning 10% this year versus 1%. It's the difference on earning the next 10% on that 10% next year. So these are some general returns here. Cash, low returns, 2 to 4%, but low risk. Bonds, 3 to 5%, low risk. Stocks, mutual funds, and ETFs, higher returns, but higher risk. Real estate and REITs, medium returns, medium risk. Private equity, venture capital, you get very high returns, but very high risk. Commodities, fairly low returns, fairly high risk, but can be predictable if you know about that commodity. And then alternatives are all over the map and fairly high risk. I mean, this is the summary of kind of the kinds of things you can invest in all over the. I mean, this is what people do with their money. Mostly people are investing in stocks. Again, 35% of money is invested in stocks, 30% in bonds, 10% in cash, 7% mutual funds, 6% ETFs. Very little money is actually in alternative investments, commodities, venture capital, things like this. Those are very small portions of the overall investment marketplace. Stocks is the overwhelming thing that people invest in, and it's a lot of money tied up in the stock market. But that money that people have put into the stock market is the money that companies are using to make investments in research and to grow their businesses. And so people look at it like when you're invested in the stock market, like you're some rich fat cat just buying a return. But when you're a rich fat cat, you're buying into companies so that they can then employ people. There seems to be this zero-sum understanding among many in our country. This like repudiation, this disdain for the stock market, without the recognition that the jobs that almost everyone holds, well, the jobs that most people hold, are in publicly traded companies that are only able to give you that job because someone decided to invest in that company. Everybody's invested in everyone else. And the whole thing is a complicated ecosystem. Trying to maximize your return can be, well, a bit of a guessing game, let's say. Now, if you want to go back to like the very beginning of the country, or at least the year 1800, these are the returns we've seen since the very beginning on this stuff. If you were to have invested in the stock market in the year 1800 and just let your money sit there, invested in various companies, and you lived for 225 years, you would have earned an annualized return of 6.9% on stocks. The $1 that you put into the stock market in 1801 would today be worth, $2,334,000, $334,920. That is a big ass return. If you had invested in gold in 1801, everyone's always touting how great gold is. You put $1 into gold in 1801, you would have today $4. So gold, $4. Stocks, $2,334,920. So play the long game. Stocks are usually a good investment. It's not because stocks are risky. It's because stocks represent the underlying value of the American people to like invent and sustain an economy. Stocks get this bad rap, but that is the economy. If you trust at all in America, that's what the stock market is. Bonds and treasury bills used to pay a lot more. 1800s, you would have made a lot on those, not so much anymore. If you would have just had money under the mattress, you would be much, much poorer today than you were in 1801 because of inflation. You would have 4 cents relative to in 1800. So don't do that. Don't bury money under your mattress unless you are really, 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 well, unless you really just need cash. Unless you're like super, 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 super risk averse. The compounding here is very interesting. You know, stocks earn about twice the rate of return as bonds since the beginning, but because of the compounding, stocks today would be worth over $2 million, bonds would be worth only $2,000. The compounding really, really, really matters. It's why you want to be invested aggressively in your 20s. You want to start buying as many stocks as you can, or as many kinds of investments as you can, when you're about 20 years old. Because that money you earn in your 20s becomes much, much, much more valuable later in time because of the compounding process. If you don't get started investing until your 50s, your 60s, you're never going to earn as much money later on. But of course, there's risk. And every time the stock market crashes, it freaks the hell out of people because you can quickly see your entire pool of investments crater like by 50%. Like everything that your life is worth in a year or two can become worth like half or less what it had been worth. It was very scary during the Great Recession. The stock market had been up around 14,000. And by the end of the Great Recession, the stock market bottomed out around 6,500. Ordinary people who had built a life savings saw that deteriorate by 50% in just a few years. It all did eventually climb its way back. And of course, now the stock market today is worth way, way, way more than it was even in its peak in 2007. The stock market peaked in 2007 before the Great Recession around 13,000. Today the stock market is up around 49,000. And so those who rode out the Great Recession ultimately were paid back for it. But when things crash, it can be very, very traumatizing to people. It can wipe out wealth. And then when everything you had is worth less, then every dollar you spend eats much, much more significantly into what you have. And when it came to the 1929 stock market crash, it took decades and decades for the stock market to make it back to where it had been in 1929. And so people get really, really freaked out. And so there's been a lot of effort in trying to identify ways for people to hedge against those potential risk events by owning multiple different kinds of investments simultaneously. So you can invest in stocks because history tells you that they have the greatest rate of overall return. But you want to basically be hedged by owning and investing in other things that work in the opposite direction as stocks. It's part of the reason that people stay invested in cash and bonds and things that pay lower rates of return, even when the stock market is going up. Because when the stock market goes down, the value of those things tends to go up. We all famously get fixated on the inverse relationship between interest rates and stocks. Well, you want to be invested in some things that ride the interest rates at the same time you're invested in things that ride the stocks. Because there are correlations between all this stuff. And The good news is, I don't know if it's good or bad today, but it's pretty easy to run all these damn numbers. You want to invest in things that are like inversely correlated in a way. If you're invested in stocks on the one hand, investing in ETFs or mutual funds won't necessarily help you because those basically just operate in the same way as stocks. In fact, they are stocks. But other kinds of stuff, like real estate, is not that heavily correlated with stocks, even though it also earns a positive rate of return over time. Private equity, venture capital, sometimes those don't work exactly hand in hand with the stock market. For instance, while the stock market was disintegrating back in 2008, if you were invested in, I don't know, basic durable goods like soap, everyone still needed to buy soap and clean themselves back in 2009. People weren't necessarily taking fewer showers just because the stock market had collapsed. So if you owned a soap company, you were still doing reasonably well. Sports teams, like buy a sports team, those did pretty well back in 2008, 2009, because frankly, when people didn't have the money to spend on really expensive entertainment, they spent a lot more money on cheap entertainment. And going to cheap sports games was a good way to, give your family something to do. Same thing for like movie theaters. They did okay back through the recession because movies, even though a movie's expensive, it's still relatively cheap compared to going to like a really fancy dinner out. Commodities not that highly correlated with stocks, and then some of these other things like art, wine, cryptocurrency, not a lot of direct correlation with the stock market. And so people try to build portfolios of things that are inversely correlated. That's the foundation of modern portfolio theory. You go talk to somebody like Merrill Lynch or Schwab or Edward Jones or Fidelity, these big companies that will manage your money for you, or your local bank will do it too. And they, ask them like, what should I put in my portfolio? How do I build savings for the long term? They're going to tell you to buy a balanced blend of these things, and the reason for that is that they're trying to maximize your rate of return while also lowering your aggregate risk. They're lowering your risk by building offsetting kinds of returns. There's a formula to it. It kind of depends on your age. It depends how much you want to weigh returns versus risk. But generally speaking, they're going to tell you to buy some percentage of your investments in stocks. What those stocks are, pick some big ones, pick some small ones, pick them at random, pick them based on the ones you like, whatever. Buy some stocks. Maybe you just buy some indexes, buy some ETFs, buy some mutual funds. Don't do it in an overlapping way, though. That's like kind of a needless thing people do. They'll buy a bunch of individual stocks and then they'll go buy a mutual fund that has all those same stocks in it. It's a waste of time. You're paying some money manager a fee to do the same things you did on your own. International stocks would be part of your portfolio. Bonds would be part of your portfolio because they work in a different direction than the stocks. They're in a lower rate of return, but they're a little more stable. And then they always tell you to retain a little bit of cash. A little bit of cash is good because you want some liquid ability to sustain your life in the event of something really, really crazy. That was the problem with Lehman Brothers, which I see coming up here in the chat, is that Lehman Brothers did not keep enough cash on hand so that when things went bad with their other investments, they could sustain their company and pay off their creditors. And so generally, you'll build a balanced portfolio. If you are younger and you have more ability to absorb risk, they'll probably put more stocks in your portfolio. If you're older and just trying to kind of maintain things, you'll do more of the fixed income. If you are like a university endowment, you will build a more balanced portfolio in which you have more fixed income type investments that grow slowly but steadily over time, and less risky stuff because you are managing money that really matters to someone. And so you don't want to put it all that much at risk. Whereas if you are a speculative investor, you're going to crank the gas. You're going to go for high volatility, small stocks. venture capital. Invest in crazy new startups, hoping one of them makes it big. You're going to invest in the next Microsoft and get in on the early days. And if you pick right, you get in on Bitcoin in the early days, you can earn a fortune. And the internet is now full of people who think they are somehow going to beat the market and identify that next thing. And a lot of people did make a lot of money on Bitcoin. Those who saw that early, got in early. I remember back in 2016, looking it up very specifically when Bitcoin was at $4,000. Today, Bitcoin is at $78,000. That's a huge, huge, huge return if you had gotten in back then. But balanced portfolio is generally what an investment advisor would tell you to do. Over the last 10 years, the highest return investments, by and large, relative to risk, highest return investments, actually cryptocurrency should really be number one here because that has, in the aggregate, done like off the charts. A lot of that was early in the last 10 years. But if you got in on Bitcoin back in 2015, you'd be rolling in it today. But, as much as people like to try to find those hidden gems, at the end of the day, just like regular big stocks, done pretty well, especially the big tech stocks, done really well in the last 10 years. NASDAQ, tech-heavy, exchange-traded funds, done pretty well. Cryptocurrency, as we said, early holders in Bitcoin have done really well. Less so if you invested Bitcoin like in the last year. Bitcoin hasn't done so well in the last year. The best venture capital funds, of course, how do you pick winners there? And then residential real estate actually did pretty well, even if commercial real estate didn't. The lowest returns in the last 10 years, well, if you just had cash sitting under the mattress, that lost value. The inflation period of the early 2020s decimated the value of your cash. Bonds didn't do so well. International stocks didn't do so well until last year. Commodity indexes didn't do so well. Investing in hogs for the long term was not necessarily the way to go. And then precious metals actually didn't do all that well in the last 10 years. Well, gold did. Gold actually did, but some of the others didn't do so well. And so at the end of the day, much as people all try to like it's snarky, like to be cynical about it, like to pretend like they have all the secret answers, basically crypto and big stocks is where you really wanted to be to make the greatest rates of return over the last 10 years. Now, if you were just looking for stability over the last 10 years, these are the things that would have given you the greatest stability. Now, cash lost value, but if you were involved in like money markets, which more or less kept up with inflation, you would have done okay there. Cash equivalents. And then other kinds of like bonds, municipal bonds, large cap stocks, like really big stocks like Johnson & Johnson, as I said earlier, Procter & Gamble. These really stock companies just like make basic stuff. People always need basic stuff. That's what Warren Buffett was like really good at, identifying the stuff that the companies just made basic, tangible, concrete stuff. Those have been pretty stable. Utilities, consumer staples, healthcare, those are all just things that people always need. Least stable investments, despite its high rates of return, cryptocurrency, venture capital, small stocks. Some did well, some didn't. Emerging market equities, like in really speculative economies of the world, those can be really, really, really boom or bust. Energy commodities, depending on what and where. A lot of it dependent on policy sometimes. Like Joe Biden wants to invest in green energy. Well, government puts a bunch of subsidies into it. Green energy companies might do really well for a while. Donald Trump gets elected, de-invests in all that stuff. All those companies disintegrate in value really fast. And I don't know, you really want to put your money on the line on the basis of domestic politics? That seems pretty risky. Quiet Castle in the chat says dividend stocks are awesome. If you like paying taxes, they are. Stocks pay dividends, you get to pay a lot more taxes. Can I just do this? Notice how this is a list of the top 10 performers, but there are only 7 performers listed. It's AI for you. Okay, best performers. This is like the same thing we just did. I don't have a second set of slides for it. Large cap stocks, mega cap tech stocks, yeah, your Amazons, your Googles. The NASDAQ did really well. Venture capital did pretty well. At least venture capital in some companies. If you can read the economy, like if you knew that the COVID pandemic was going to happen before it happened, like if you're the person that was inventing COVID somewhere, theoretically, somewhere in a lab, you're inventing COVID, you could probably also on the side be investing in a company that makes masks because you know those are going to do pretty well. That's where people get lead into like sketchy stuff. People try to invent shocks in the marketplace. You know, every time Donald Trump tweets something, he can impact the value of stocks. Well, he can also invest in those stocks. So it gets a little hairy with these politicians. Sometimes they know things ahead of time. All right, so these are some of the best performers. These are some of the bottom performers. We just talked about this. Okay, we just talked about this. I'm not going to go over this again. That would be very silly. Okay, 10-year performance of commodities. So this whole thing started with we wanted to talk a little bit about silver. Silver has done okay. Precious metals down there, 4th out of 7 of the different kinds of commodities. In the last 10 years, energy did the best. Industrial metals, the kinds of metals used in electric vehicles, like copper, for instance, did really well. Fertilizers, number 3. There are a lot of food security issues across the world. Precious metals like gold, silver, number 4. Soft commodities, number 5. Agricultural crops, number 6. Didn't do so well. Livestock did very poorly because increasing feed costs and biological cycles. For some reason, the cows and the pigs didn't do so well over the last 10 years. And so you should not have invested in them. So I see here in the chat, Tilt is asking, do you think the silver market predicts a bust? Well, this is the history of the silver market. It's been kind of erratic, to say the least. Silver generally is treated as sort of a stable currency thing. People, in theory, load up on currency, on like stable assets like silver, either before or after a major bust, because they think that it will be a way of basically offsetting the uncertainty of the stock market. Silver is interesting in particular because it's like a second thought that people have after gold. And so like people are weighing in their minds not only the stock market, but like also gold. And then they start investing in silver. For a long time, silver was just very, very stable. 1934, the Silver Purchase Act required the U.S. Treasury to buy large amounts of silver. And so silver became very steady, kind of maintained value alongside the U.S. dollar. There was a giant spike in silver in the 1970s and then really, really accruing in 1980 after the U.S. ended the gold standard. There was a thing in 1980 that caused a particular spike in which one family tried to corner the silver market and drove its value through the roof before it subsequently collapsed almost immediately. And then it kind of became a stable thing again for a while. And then people started, really kind of buying up silver in the 2000s. Some of them before the crash, hoarded up on precious metals. But then it was really after the 2008 crisis that people bought a ton of silver because they were all freaked out about the stock market. And then as soon as the stock market stabilized, the value of silver cratered. And since then, silver's been popular. And part of the reason silver's been so popular over the last few years is that gold has also been really popular on the back of a whole bunch of media campaigns and companies that have peddled commercials, especially to conservatives, to buy gold under the fear that doomsday is coming. And so there's a lot of people that think the gold market is like oversaturated because the price of gold actually has gone up a lot. And so people have started turning to silver. And there has been a spike in silver over the last year. I have gold. Okay, here I have gold. Here's gold. So gold, as you can see, that's like gold's just gone up. Gold was like super steady for a long time. And then after the end of the gold standard, gold has basically been more erratic in value, but still pretty steady until the 2000s. And really, if you bought gold like in the year 2000, gold has actually done really, really, really well. Gold has actually literally outperformed the stock market since the year 2000. It's speculative. People have been buying gold because they're afraid of the stock market. Now, the total amount invested in gold is still very, very, very small compared to the amount invested in the stock market. But it certainly has gone up, and gone up without as much. I mean, it's gone up more steadily than silver. Silver has been a reactionary thing to gold, but they've both gone up. Reading what people are doing with silver right now, I mean, you're kind of reading more into like what people think than you are the actual market itself. It's how much do you trust the wisdom of your neighbors? Sometimes you trust the wisdom of the market, but how much do you trust the wisdom of the paranoid people that listen to talk radio? Now, I'm not saying there aren't a lot of great people that listen to talk radio, but the people that buy into gold and silver in particular tend to be in those corners of our universe. You're very rarely going to walk into like a mainstream stock advisor's or a mainstream investing advisor's office and hear them tell you, we think that the best thing you should do for your long-term wealth is to invest in gold or in silver. The investing in silver over the course of the last year is largely a response to, number one, the belief that gold was oversaturated, and number two, the volatility in the U.S. economy. Since Donald Trump took office, people have been really, really, really on edge about the economy being erratic, not so much an impending collapse, but just simply uncertainty about what was going to happen with tariffs, what Donald Trump might do erratically on the international stage. If Donald Trump goes and pisses off Europe so badly that everybody disinvests in everybody else's economy, who the hell knows what's going to happen? If U.S. and China get into like a nuke war, everything could go to hell in a handbasket in a second. The discontinuation of all this federal investment, federal programs, people have just been really, really on edge and uncertain in the last year. So even as the stock market has actually done really well in the last year, people also have been hoarding up on the precious metals. Whether that will stay, bit of a question. Anyway, I'll come back to gold and silver here in a minute because I do want to talk more about that. You also have things that have gone up a lot over the course of the last 10 years. Crypto being one of them, and they've been investing in like Bitcoin and then other speculative coins, believing they have found some kind of new utopian kind of investment. And reality is basically any time in history that people believe they have discovered some new utopian kind of speculative form of investment that does not have an underlying value in the economy. What goes up must eventually come down. The Dutch tulip bulb crisis we were talking about the other night on the stream was the first example of like a massive irrational bubble in which consumers got really, really, really irrationally excited about the value of tulip bulbs and started investing speculatively in them to the point where people would invest their entire life savings in a single tulip bulb. And of course that crashed. Crypto is weird because it doesn't actually represent anything that the economy is making. It is a quote-unquote currency, but it is a speculative investment currency. And I'm not going to spend this stream digging into the whole mechanics of crypto and the like de-exponential way that crypto increases. There's sort of a cycle that basically is starting to emerge here when it comes to the value of cryptocurrencies over time. A gradual accumulation leading to a really, really, really rapid and radical markup in the value of that currency. As the currency becomes more mainstream, it becomes distributed, and then eventually the markdown on that currency as the amount of that currency basically levels off, and then people become disinterested in it. And this is kind of what's going on in Bitcoin right now. We saw this massive, massive, massive spike back in the early days of Bitcoin. And it's kind of been stable and declining ever since. This is the 5-year trajectory of Bitcoin. Now, in a way, this has done pretty well. If you bought it in 2023 and sold it in 2025, 26 early, you would have done pretty well. But if you bought it in 2022 around 50 and you sold it here in 2026 around 78, that's really not any better than, I mean, it might even be worse than if you just bought stocks over that same period. So Bitcoin is starting to become less of like that magic bullet investment for people relative to what it used to be. And it's starting to kind of embody the cycle that everyone predicted for it. Here's Bitcoin in just the past 6 months. If you bought Bitcoin 6 months ago, you'd be screwed. If you bought it at 115, you'd now be at 88. People lose money on Bitcoin every day. And again, it's because Bitcoin, like Warren Buffett would tell you that Bitcoin is not the kind of thing you should be speculatively investing in if you don't know what you're doing, because there's no underlying value to it. Bitcoin doesn't actually represent anything. The value of Bitcoin is entirely in what people are speculating on it. You're chasing like the crowd putting value into it just for the sake of amplifying their returns. It's a house of cards. Whereas if you were investing in something that actually has concrete value that you can understand, like you make soap, people need to buy soap because they wash with soap, that's a thing. That's a thing that has value to it. So Warren Buffett would tell you not Bitcoin probably, but invest in like real stuff. So here you go. This is since 2000, Bitcoin annual return 50 to 70%. That's insane. If you got in on it early, you would be rolling in it. Even today, you'd be rolling in it. But most people didn't get in on it early enough. Same way people didn't get in on Microsoft or Apple or Google until many years later, and while they may have done fine, the people that really made bank on it were the people that got in early. U.S. stocks have done pretty well since 2000, earning 8% a year. Gold has actually very slightly outperformed stocks. That is crazy, given that gold is basically designed to be a hedge against volatility. But gold has become more volatile now. Precious metals are not the stable thing that they used to be. They just operate kind of on a different volatility cycle than the stock market. Silver is becoming extremely volatile, more volatile than gold, lower aggregate returns since 2000, weaker long-term compounding. And then cash, treasury bills, very, very slim annual returns since the year 2000. Often negative after inflation. Well, yeah. You know, that's not where you want to be. That's not where you want to be parked. All right, what do we got here? Okay, so this is like a rule of thumb for you if you are investing. How much should you have invested in your retirement account over time? Now, obviously, the more the better. The more you can pump into your retirement account in your 20s, the more it will have the opportunity to compound over the course of your life. Get it in there early. Live cheaply in your 20s. Build up a retirement account so you can live on the compounding of passive investing while you're continuing to work over the ensuing years. But This is what they would say is like a rule of thumb. Given the understanding that most people don't make that much in their 20s, you're struggling to get by, you're paying back your student loans, all that kind of stuff. By age 30, you want to have invested in your retirement account at least the equivalent of 1 year's salary. These are actually a little bit low numbers, I think, relative to what I would generally think would be recommended. But by the time you're 30, 1 times annual salary. By the time you're 35, you want to have a retirement account that is twice your annual salary. Because you're investing more every year, and what's in it is compounding. So these get more rapid over time. By the time you're 40, you want to have 3 times your salary in your retirement account. By the time you're 45, 4 times. By the time you're 50, 5 or 6 times. By the time you're 55, I would say like 7 to 10 times. By the time you're 60, I mean, really, if you only have 10, 12 years saved up here, you probably want to have a little bit more, unless you're going to live really, really cheaply in retirement. You probably want to have 20, 30 times your annual salary saved up, ideally, if you can, by the time you retire. But, beggars can't be choosers on this stuff. Just save as much money as you can and check it against the benchmarks along the way. Okay, underlying message here. Does the volatility of silver portend the end of days? Probably not. The end of days could come anytime. And, the people that invest in the most stable stuff, great. But, if the end of days really does happen and the entire American economy collapses, the fact that you have silver, I don't know if that's really going to be that valuable because, again, silver is only as valuable as the value that people place on it. And if the entire economy collapses and everyone's investments deteriorate, people aren't going to be paying that much for silver either. Silver is also going to fall apart. So I have never really understood the notion that gold and silver are these great hedges against the doomsday scenario. If you believe that the apocalypse is around the corner, just hoard food in your basement. Gold and silver ain't going to save you at that point. They might save you from a stock market crash that is temporary, but they're not going to save you from the ultimate apocalypse. The best thing you can do, by and large, you don't have to listen to me, but generally the best thing you can do is invest in things for which you understand their intrinsic real value. Don't try to start investing in these things that you don't understand, that are these speculative, wild internet things. Learn about them, see if they have value. But the kinds of things that you use in your everyday life and that you see other people using, invest in the companies that make those things and sell them. It's pretty darn simple. Investing is not some magical guessing game. The reason things go up is because they sell. McDonald's stock goes up when people buy more McDonald's. So look around. Find the things that people are using steadily, recurringly, and in increasing ways that will stand the test of time. Everyone wears shoes. Invest in shoe companies. Most people wear clothes. In most places, you have to wear clothes because it's the law. Invest in those. Increasingly, people use smartphones. That would have been a good investment 20 years ago. They've increased. Maybe we're going to invent something tomorrow that renders the smartphone useless in 5 years. Maybe there will be research that comes out that proves the smartphones are giving us all cancer, and everyone will be encouraged to stop using their smartphone. And we'll look back on it like the early days of cigarettes. And then probably the value of your Apple stock will deteriorate. Find the stuff that actually has real underlying value and invest in the companies that make and sell that stuff, because that's the stuff that is going to hold and increase in value over time. It saves you the need to go out and make shoes in your basement to sell them to your neighbors. The shoes that you make in your basement may be better than Nike shoes, but they're not going to be better than most kinds of shoes. I only say that because I've had so many damn pairs of Nike shoes collapse under my feet. The fact I've had literally 3 different pairs of Nike shoes literally collapse under my feet while wearing them when those shoes were only like a couple years old is a crazy indictment on the crappy value of those products. It's a crappy quality of those products. Like, what is the stuff that people like to eat? What are the trends people are really getting into? Everyone's sitting around watching TikTok. I don't know, find a way to invest in TikTok. Like, don't hate on the popular stuff. Go invest in it. You know, you can rag on the 6-7 meme all you want. Go buy stock in 6-7. Actually, that's a really bad idea because eventually the 6-7 meme, it has now died. And so that stock would deteriorate rapidly after its peak. Find the stuff people are doing and go invest in that. And I don't know, like, I don't actually see that many people eating silver every day. So am I going to go invest in silver tomorrow? Maybe, but probably not. I don't know. I shouldn't tell you guys my investing strategies for myself. And I could be giving you all kinds of thoughts here that are completely countervailing whatever I would do with my own money. So who knows? You're on your own. You're on your own. Just do whatever you want and complain later. And we can all commiserate once everything falls apart. And I mean, it feels like the world is in a very precarious state. I know that's like, makes people nervous. Maybe the stock market is overvalued right now. I'm a little nervous right now because the stock market seems like a little high. But I don't know. Depends who you talk to. I have no thoughts. I have no advice on that. And maybe the people that are investing silver are telling us something. Maybe it's a canary in the coal mine. People are getting skittish about the state of our economy. And remember, there's a big world out there. A bunch of stuff happening. You can invest in stuff anywhere in the world. Just sit there and they're like, it's impossible to get ahead. You can't do anything in the world. Life is a nightmare. I don't know, like, scrap $50 together and go invest in something in, like, I don't know, the Middle East or Africa or some weird place where you see stuff happening. Like, at least live an interesting life. If you don't believe you can get ahead, at least live an interesting life. And if you can't afford a vacation to go do that, you can go buy into, like, the Shanghai Stock Exchange anytime you want. And that's exciting. All right. I'm gonna pause it there. We've been ranting and raving here for a little bit about the stock market. I wasn't really sure where to like dig in on this because we've been talking about having about doing like a stream on stocks or investing or gold or crypto or silver or stuff like that for a long time. I wasn't quite sure where to dig in, so I thought we got to get like the foundation set here. Well, actually, I wanted to do a stream on just like how the economy works and talk about the whole Federal Reserve and all that stuff. This wasn't that. This was like more practical. Like these are the investments that you can theoretically invest in. But this is like investing 101. Think of it that way. And if we need to do more detailed streams, we can. But judging from the numbers, this is not that popular. So I don't know what's going on there. Very boring content, apparently. All right, let's see what you guys are saying. Well, first we should do an ad. I need a number 1 through 15. 1 through 15. What are you guys thinking? I need an ad. Let's see. Nobody wants to give me a number 1 through 15. Oh, Spy 5. Yeah, I mean, I don't blame you. Like you're walking into your own I mean, it's not as bad as being executed to have to endure an ad, but it is sort of like walking to your own execution to provide the number of the ad that you then want to have to watch. Okay, we're gonna do number 5 here per Spy Man. We'll find this. We'll see what it is. I don't know what it is, but we'll find out together. It'll be exciting.
Hi, Quiet Castle here. I hope you're enjoying our interactive chat. If you like hanging out with us here on YouTube, just a reminder you can continue the conversation over on our Discord. It's a fun place to hang out. We have questions of the day, you can post links and memes, post photos, debate things, and chat with your fellow land ducks any time of the day or night. It's also a great place to interact with the mods and with land directly. It's free to join and easy to use. You can open it right up in your browser, so give it a try. The link to join is in the description.
All right, we are back here on Land Speculation on YouTube. That was moderator extraordinaire Quiet Castle, who was being a very loud castle by extemporaneously reading that ad. He extemporaneously read an ad. I guess you could do that. Anyway, follow his advice. Like and subscribe. Check our description for the link to our Discord, our Duck Fund, and our sister channel, Land Ducks International, where we continue posting stuff. So, join that. All right, let's see what we got here in terms of thoughts from folks. We'll do a little bit of the wisdom of the crowd here. Oh, should we jump back? Okay, we'll jump back up all the way to the top and see what you guys got going. I do appreciate some of the additional folks joining us here in the chat along the way. Lurky, Jerry Carter, Spyman. I can't remember who I greeted at the beginning. Tilt-A-World. David Miller, I believe, was in there. Puffed Off was in here. I puffed off. Let's see. It's kind of like weird to me which of our videos I've been, now that we've been posting a lot more close to daily videos of late, and I've been watching the performance of those videos and the analytics that they give me, and it seems to be like profoundly random which videos get like a lot of views and which ones don't. A random 3 a.m. ramble stream the other night has subsequently done really well. Has like a lot of views on it. And then other things where I put like a lot of time and effort into them, they don't do as well. So I guess it just goes to prove that the more effort and time you put into something, the less valuable it is. So be lazy. Speak extemporaneously off the cuff and don't do any research. That's what I've learned. It's a good life lesson. Okay, it's not letting me scroll all the way back. Interesting. Spyman keeps money hidden in his freezer door. Oh, I'll keep it cold, I guess. It would take me hours to type all the places I hide money. Well, if you typed us the names of those places, you wouldn't exactly be hiding it anymore, would you? Old money in coffee cans and then bury them all over your backyard. That's a way to do it. Yeah, you can hide money in a lot of different places. Doesn't mean the money's going to increase in value, but it will be in those places unless some vermin eats it. All right. The trick is to make your money work for you. You've already worked to get it, says Quiet Castle. Well, you're going to pay taxes on it like a dozen times over, so you better as well hope that you can earn some value on it along the way. Quiet Castle says buy low, sell high, which would be great if you could predict when low was and when high was. Quiet Castle, speaking of cash, everyone should have a high yield savings account that currently returns around 3.5% instead of a standard bank savings account that usually returns 0.01%. Yeah. Well, I mean, it's not like the worst thing in the world to have like a small checking account, even if it doesn't earn that much. But most of your cash, yeah, you want to keep. I mean, the savings accounts have been paying a fair bit the last few years. They're a little bit less than they were back at the peak of the inflationary period, but still doing better than zero. So for sure. A lot of people don't have as much interest to spend, the effort to find out how to make more interest. Yeah, a lot of people like it's amazing the inertia you can feel. Like you spend so much time in your day-to-day life on minutia that like doesn't actually earn you anything, and then things that could like instantaneously overnight make you a ton of money. People just sit around and they don't do it and don't bother to learn about it. And the nice thing about this stuff is like it is passive. You really don't have to have any expertise. You don't have to know how to pick stocks to make money in the stock market. Jeanette says, I like the idea of stocks myself, but doing the trades myself seems a bit scary. Well, for sure. That's why, well, you can turn your money over to a managed account with an investment advisor. They'll do it for you. They'll pick the stocks. They'll just take a little percentage off the top. Or you can buy into a mutual fund or an ETF. You can buy an index fund and just buy the entire stock market. That's probably a good way to do it if you don't feel comfortable buying individual stocks yourself. Money is the root of all evil. The richest people I know are surrounded by family and friends, says Jerry Carter. Well, I mean, most people you know are surrounded by friends because if they weren't surrounded by friends, you wouldn't know them. Okay, let's see what else we have here. I'm jumping around somewhat randomly, so I'm not skipping comments intentionally. I'm just going along and Jerry Carter, I don't want to give my money to someone else to invest for me. I would pick a cool company name. Yeah, it's like picking horses at the racetrack. That's how you want to do it. Just scan the list of companies and just pick one that sounds cool. All right. Lurky, it's not showing that you have a crown right now, Lurky. So maybe your crown was taken from you. Maybe you were overthrown. As not want growing capital to keep locked in some bank vault, you invest in stock market. That is a somewhat incoherent but generally accurate way of explaining the shtick there, Village and Neck. Appreciate that. Okay, REITs, high dividend yields. Yep. Go buy a farm. You will be happier. No, farms are a lot of maintenance. Unless you know what you're doing with a farm, you're not going to make money on a farm. And farms, especially individual farms, don't make nearly as much money as they used to. My landlady's husband passed away and left her stocks in a washing machine, the company he bought in the 40s, and it was bought out by CBS and Viacom. Like before or after? I'm sure there's a lot of stories like that. People that don't even know they own something. Past performance does not guarantee future results. That's true. But past performance can give you a relative idea of the volatility in expected future results. Like, you're not going to be able to base next year's performance by a stock on last year's performance. But if you look at like the last 10 years of performance for that stock and you average its rate of return and the average volatility for that stock over those 10 years, you can relatively well predict an average rate of return into the future, as well as a likely amount of variability in the expected return. And if you want to dig into numbers that you see on Google Finance or Yahoo Finance, if you dig down through, sometimes the numbers they give you, they will have gone ahead and done those calculations for you anyway. You could go down and look for the alpha and the beta. I'm just gonna get into that. We can get into that on another stream, but like you can get into some pretty advanced metrics, even on some pretty basic platforms, to understand past rates of return, past rates of volatility, and then the amount of expected return you should expect relative to the amount of volatility, and then how much that company, based on its past performance, is over or underperforming relative to the expected return relative to its risk. That's like a mouthful. You have to make more than 3% just to keep up with inflation, generally speaking. I mean, it depends what inflation is, but right now, yeah. Villagenac, Greenland is permafrost. Under there, who knows what we can find so very rich. In theory, there could be some precious metals there under Greenland. You got some speculation. That'd be a speculative investment to invest in Greenland's speculative metals. You invest in painting and Villagenac's poems. They could someday be worth a lot of money. A land speculation S&M company could one day be worth a lot of money. Jeanette cooked a pork belly today. Interesting and off topic. Jerry says the way Land knows investments and such, it could reveal his real life profession. I fake my way through all kinds of topics on here. I speak authoritatively about things that I don't know a damn clue about here all the time. I do like 10, 15, 20 minutes of research ahead of a stream, just enough to learn enough talking points that I can sit here and pretend like I know everything about the subject and speak dismissively to those who disagree with me. I try to not do that. But it's actually one of my favorite things about doing these streams is the ability to learn very quickly about a random topic enough to be able to effectively give a lecture on it, which is basically what these streams are when we do the deep dives. And sometimes, like, as soon as I give it, I forget the information. Like, we've given deep dives on stuff that I couldn't repeat now because I have subsequently forgotten all the stats that I memorized at the time. But I wouldn't assume anything, Jerry Carter. Lurkey started collecting lead soldiers over 50 years ago. The little figures are worth $15 to $20 per figure now. Just make sure they don't have lead poisoning because that can really mess up the brain and they could get themselves into a lot of criminal or legal trouble later. Been a lot of research on that. People with a lot of lead in their bodies tend to commit crimes at higher rates. Jesus said, "Silver and gold I have none, but what I have I give unto you. Whatever that was, it might be worth investing in." Investing in, like, love, I guess. I mean, the Judeo-Christian work ethic that came out of the genesis of Christianity is the undergirding for the entire Western economy, which has done pretty well at creating value for the world. So I guess in that sense, Jesus did create a fair bit of value, as well as moral and spiritual value for all of humanity for all time. All right. Yes, please help our channel by making a comment or two on our other videos. Yeah, even if you participate in our live streams, the YouTube algorithm is more benefited by you going and commenting on our other videos. So I appreciate people going and making random comments on our other videos, offering your additional thoughts beyond what shows up in the live stream comments. All right, 2009 was bad. I've never been able to make my way all the way through Forrest Gump. 2008 was probably the worst and scariest year. 2009 was bad, but we were kind of used to it. And then 2010, we started kind of clawing out of stuff. If you could send one word to yourself back through time, what would it be? Bitcoin. And I would send that back to myself, I don't know, like 12 years ago. Yahoo's another good answer. Well, I don't know. I mean, Microsoft, Apple, Google. Or I would do like that commercial back in the day, and I would take like a meaningful message and I would just remove all the spaces in it and send it all as though it was one giant word. And then I could communicate more. The older you are, the less likely they are to respect your intelligence. It depends. Okay, who's the they? But yeah, there is something going on there. Like, older people tend to be wiser, but younger people don't always respect the opinions of older people. Yeah, mattress money loses money every day. True. I'm old-fashioned, don't trust crypto, says Quiet Castle. Genetic engineering is a great investment. Yeah, but there's there's some speculative stuff out there. You would invest in like companies that will like are trying to find the links to get your smartphone directly plugged into your brain. A lot of top end capability there. The experts are often salespeople for customer facing. The true experts and insiders see it coming. There are also people who own something called a Bloomberg monitor. Yeah, those Bloomberg portals are interesting. There are a lot of experts who are wrong a lot of time. I mean, there's been a lot of studies on, expert stock performance. And, the reality is like very few people actually have the capability to predict the market. Bernie Madoff was famous because he achieved very stable returns every year. And that didn't turn out so well. I mean, there are companies. There are companies that like really, really, really over long sustained periods of time are able to vastly outperform the market. For a long time, Berkshire Hathaway was like that. There are a few notorious REITs like that. But it's really, really, really hard. You got a lot of really smart people working for you in order to be able to do that and be really focused. Trump invested a lot of money into Mar-a-Lago, which is risky considering that it's only 5 feet above sea level. Well, a lot of people are investing a lot of money into coastal properties, and that should tell you something about how much they actually believe in the risks of climate change to raise sea levels. All right. David sent us a duck. Appreciate that. Like a duck cryptocurrency. We seem to be a little oversaturated in the cryptocurrencies right now. David uses soap on a rope. Yeah, that kind of came and went as a fad. Phylogenetic is not an enemy to the USA. I will go ahead and communicate that to the FBI. That's nice of you to clarify. Just find yourself a sugar mama, says David. That could be a way to earn money. Yep. Find someone that will pay you for having intercourse with them. I mean, check your local laws before you start doing things like that. And maybe get an STD test. or we just win the Mega Millions lottery. Anything where basically less is being paid out than the amount invested in, and that's like a fixed known reality, is not necessarily the greatest thing. You could bet on horse races, bet on sports games. Jeanette has food in the basement. I mean, it's okay to have like some food in the basement. If you have 10 years of food stored up in the basement, that's probably excessive, but maybe it's not, because maybe someday you'll be right. Invest in grocery stores because everybody has to eat, says Spyman. Not a bad thought. And toilet paper companies. The economy has to get pretty bad before people literally like stop wiping. Land literally did have shoes fall apart on a live stream once. That was quite unpleasant. Companies that bottle water. Man, like going back and investing in Evian in like 1989 would have been a good investment. David, prepared meals recommendations. Those all seem like ripoffs. Plus, you still have to do the work. Like, just go out and get food from a restaurant. Would be my advice. Ducks invest in bread manufacturers. Yes, investing in bread. That's good. People do seem to like bread. But then like you get like a trend, like all the ducks go on the Atkins diet and then the bread goes down. There's always risks. There's always risk. And so, there's always going to be risk. Any kind of investment has risk. Appreciate the comment there, Quiet Castle. If you follow Land's advice, go ahead and pour your savings into Bud Light. So this is Bud Light's a good example here. Like Bud Light obviously like blew itself up there a few years ago. That's why you don't try to pick and choose winners on the individual stocks, because beer consumption overall has actually been pretty stable. But which companies were selling the beer changed a little bit there, because Bud Light collapsed, and then Modelo actually was a big beneficiary of that. Corona was a big beneficiary of that. And so if you just bought a beer mutual fund, you would have probably done better than if you had just invested in Bud Light. Because who saw that coming? I don't know if they have like a beer mutual fund. Oh no, it all jumped back down again. Let's see. I need to post a poll. What should I ask? Jeanette owns a farm. See, Jeanette, if I were, like, that's my point though. Okay, so like for you, having a farm is great because you know what you're doing. See, if I were to go invest in buying a farm, I wouldn't know what I was doing. Now, I probably know a little bit more than some other city slickers because I actually have been on farms before. And I know people that like live on farms and sell farm equipment. I know people that like sell agricultural products. I know people that run farms. I could call them and I'm like, so I just bought this farm. What do I do now? I go on AI. It's like, I just bought a big farm. What's step one? And the AI would be like, step one is harvest crops. And so I would go do that. I would only buy like one of those like luxury farms where somebody else has already done all the work, and all the crops have like already been like turned into like a big buffet that's sitting on the back porch. I'm like, look at my handiwork. Now I get to eat it. But see, like, it's instructive because, like, if I were to buy a farm, that'd actually be a bad investment for me. I would do very poorly with it because there are experts like Jeanette who actually know what they're doing owning a farm, and I would be competing against Jeanette when I take my crops to market. The same thing is the case for when you try to pick individual stocks. Like, somebody else knows which stocks are going to do better than you do. Minus 17 in International Falls, Minnesota right now. That's very cold, Spyman. I was talking to people in Canada earlier. Very, very cold there, it sounds like. DC, a little warmer. There's a rumor we might actually get above freezing tomorrow. Okay, let's see. The winner tonight is Spyman. Congratulations to Spyman on your victory here tonight. Excellent, excellent job. Did we put something controversial in the title today? Usually, like, part of the reason when I can, I try to stream on Monday nights is that Monday is obviously the biggest TV night of the week. And if we aggregate like all of our streams historically on the analytics, Monday and Sunday night streams do the very best of all the streams, followed by Thursday night. Those are the three best nights of the week to stream, just as they are the three most like high prestige nights on television. You know, that's why you have the great TV shows, the dramas, the sitcoms, always on those nights. That's why you have Sunday night football, Monday night football, and Thursday night football. And so along those same lines, over the entire history of our streaming, the streams we do on those nights get more views than the other nights. And yet tonight's numbers are abysmal. Like, yeah, crypto, could be the crypto. I don't know, guys. I wonder what happens if we take that out of the title. Let's see. Stream settings. Let's see. Silver. Let's see. If we take. All right. We've modified the title. See if that helps. I don't know. You guys showed up, but nobody else did. Maybe people will watch it after the fact. We'll see. But it would help, guys, if you do drop the like and the subscribe in the video. Those likes help us out with YouTube. The subscribes help you guys know when we're on. Make sure to do that stuff. I appreciate that we're like a family here all trying to make me rich. Top fans tonight, let's see. We have Spyman, Tilt-A-World, Jerry Carter, Veliginac, Lurky, David, and Puftoff. Excellent job. I don't know what the XP gets you, but you get points, apparently, for being a top fan. A lot of retired people have managed retirement accounts, usually because they have to have a minimum amount before somebody's willing to manage your money. They have to make it worth their time. And retired people have more money saved up. People watch videos of stupid stuff, yet videos where you can learn stuff aren't as popular. That's a good way of summing up the internet, and it kind of explains like why, yeah, I mean, not to be a snob about it, but like, because we all do it. Like, we all go watch the brain dead stuff. This topic isn't a general interest topic. I mean, you say that. 62% of Americans invest in the stock market to some degree. I mean, it's like, it's a topic that isn't a general interest topic. It's weird that it's not a general interest topic because of how much people like money. Like, everyone kind of agrees that they like money. Everyone wants to be rich. And so it's a little weird that something where you literally can get passively rich without doing that much work is not more popular. You can also get passively poor, so there are trade-offs. Well, we gave it a shot here. Hopefully this was an interesting start to a conversation about investing. We can figure out where we want to drill in deeper. Like a dentist gone mad, we will drill in as deeply into your skull as it takes. My skull. Take a drill into my own skull. See how deep I can plow. You probably eventually get past the nerves and then just like drilling through bone. I guess, does that still hurt? I don't know. It's really not worth even bothering to wonder about because that would be very silly. All right, well, that's about all we're going to do for now, I think. Let's see, how we doing here? Yeah, okay, well, we did pretty well on time. Okay, well, we'll come back with either more dynamic and sexy and volatile attention-seeking streams with highly graphic and clickbaity headlines or something, and or some fun stuff or newsy stuff or something else. More to come. You guys have the gist by now. We don't always stream, but we sometimes stream. And we don't just stop streaming unless we die. Someday we'll die and then we'll stop streaming. Or maybe someone else will hack into the account and then they'll stream from this account and then that'll be confusing, but you guys don't know the old history, so you can be the old people that like, you know, tell the war stories of how it used to be. Back when Land used to stream before Jim Bob hijacks our channel and starts streaming from it. Try a stream about Jesus not having gold or silver. Try a stream about Jesus in general. Nightbot says lion. And Quiet says hi to Mrs. Land. Hi, Mrs. Land. She's been sitting here staring at the chat the whole time. That's not true. She hasn't. But I will say hi to Mrs. Land. Appreciate that. All right, guys. That's what we got for tonight. So yeah, good times, good times. Thanks to our mods. Quack Castle, Jeanette, doing the heavy lifting here tonight. Appreciate it very much as always. And to the rest of you, it's been a blast. Go forth, become wealthy or don't. I'm not here to provide recommendations. Do whatever you want. If you want to be rich, be rich. If you want to be poor, be poor. You want to be in the middle, be in the middle. And then figure out the how after that. Pick what you want and then seek it with your full heart, faith, and desire, and skills and talents and best guesses and efforts, and eventually disintegrate into dust that is then eaten by worms, and then your soul goes somewhere off into eternity, and some mystical thing that we don't understand because our sensory capabilities are limited will happen to all of our existential beings. Sweet dreams, everyone. Don't be strangers. We'll be back. This is Land. That ain't just speculation. For now, I hope you all have a good night.